Hello everyone, I am Horatio Abernathy, and this is the Cash Flow Portfolio. And today we're looking at the risk-free synthetic cash collar portfolio. Risk-free? How's that possible? Stay tuned. So, let's go to our Thinkorswim platform here. And we're going to buy ourselves 100 shares of SPY, the S&P 500, 1/10 in SPYs. Okay, so first thing we're going to do is buy 100 shares. Now, a share is selling for $637.43. So that's $63,743. That's the cost of those 100 shares right now. It's a lot of money. Okay, so now the first side of this trade is 100 shares of SPY. Now, our maximum loss if we buy these shares is $63,743. I don't like that. I want to lose nothing on this trade. How does that sound? Okay, so we're going to put a collar on this, a stock collar, using options. A very standard procedure. Okay, let's go to, say, 34 days. Keep this for about a month. Okay, so now it says 637.43. Let's say 638, tiny bit in the money. I don't want to lose a penny. Okay, we're going to buy one contract for 100 shares at $9.03. Now we can't lose any money except the cost of the $9.03 if the price goes down to zero. So far I like that. But I don't want to pay for the whole thing though. That insurance is too expensive. So we're going to go to a little higher here. Let's go to 645 and sell ourselves a call for $6.82. Now our maximum loss is going to be the difference between the cost of the put we bought, and the call we sold to pay for some of it. So let's look at the chart down here. Okay, so we're looking at $161 is our maximum loss. Maximum gain is $539. Not bad. Okay, well, I don't want to lose 161. How does that sound? So we're going to find a way to hedge this. We're going to go to XSP, and that is the cash settled index of SPY. So basically it follows SPY percent by percent. If SPY goes up 1%, so does XSP, and vice versa. So it follows, it kind of mirrors it. But they can't take your stock. You don't own stock. It's just options. And at the end of the day, they either put cash in your account or they take it out. But there's no stock to take, though, which we like for this strategy. So let's go out 34 days. Now we're going to put what I call a bear box on this to make sure we cover that loss. So right now it's selling for almost $639. So we'll go for $639 and we're going to sell a put. Try it again. Sell a put, and we're going to buy a call. That's the long position. Now I'm going to do the opposite to complete the box, a short position. So we're going to sell a call $1 lower at $638, and we're going to buy the put $1 higher than the at the money at $640. Okay, there's our box complete now, a bare box. Let's see what it looks like here. Okay, so if this if SPY goes down, we make $127.50 on this. Now, our greatest loss for SPY was $161. What if SPY goes up? Well, it's going to cost us a loss of $72.50. Okay. But how much we make on SPY if it goes up? Let's take a look. So SPY goes up. There we go. We'll make $5.39. So 539 minus the 72.50, we'll make $4.66 if SPY goes up. If SPY goes down, we'll lose 161 minus the 127. We'll lose $34 in the entire sale. I said no risk. I mean no risk. So let's do something different now. We're not going to buy that stock anymore. Get rid of that. We're going to use options to create a synthetic stock. So that means selling a put and buying a call. Let's go out about 158 days. Okay, and now we want to go to the 50 delta. We're going to sell a put. We're going to buy a call. Okay, so now instead of buying 100 shares of SPY, we've created a synthetic stock with approximately 100 deltas. Here, 102. 100 deltas is like 100 shares of stock. They move together. One goes up 1%, other goes up 1%. However, it didn't cost us any money. We just needed 25% of the value of that $63,743 in our account. Well, we're going to keep that money in Treasury bills. And we're going to get about $258 for those 34 days. So now, that what, $34 we're going to lose? We're making $258 on the Treasury bills. That covers the loss. So stock goes up, we make $539 minus the 72. 529 minus the 72. That's 457. Plus we're making 258 on the Treasury bills. Now we're making 1750 total profit. Our maximum loss? Nothing. Because our loss is covered almost 100%, which you can do if you want to. You just got to play with the numbers. But the maximum loss is now covered by the bear box on XSP and the income that comes from the 4-week Treasury bill, or 34 days basically. Okay, and that will cover the loss, the extra loss on the trade if SPY goes south. So there you have it, folks. That is the risk-free synthetic cash collar portfolio. You don't buy 100 shares of SPY, you create a synthetic stock. You stick the cash that you would have used to pay for that stock in Treasury bills for 34 days. That covers any loss you would have had on the SPY XSP, the synthetic cash collar, and the bear box, XSP bear box. Either way, heads I win, tails I win. I like this. So remember, don't try this at home. Options are very dangerous. You can get burned. So study, 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 test, test, test. And this is the program that we're working on now, and we're testing it right now, but so far, so good. So, that's it for today's show. We thank you for joining us again. And try this out on your Thinkorswim virtual trading platform before you do it for real. In case there's some surprises, we have no idea are coming. Anyway, that's our show for today. So goodbye, good luck, and happy trading to everybody.